Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode, we're talking about deposits. Which banks boast the strongest funding, what attributes they have, and how deposits continue to drive valuation across the banking industry, even with the Fed seemingly poised to cut rates again today on September 17th. We recently co-hosted a conference focused on deposits with our friends at South State. At the event, we covered the competitive and regulatory landscape, ways to analyze and optimize the deposit business, and highlighted some of the best franchises in the country through fireside chats with their executives while sharing the results of our proprietary deposit rankings. My colleague, Zain Tariq, spearheads those rankings and took part in the conference and is joining me on the show today. Zain, thanks for being here.
Thanks, Nathan. Excited to be here.
So Zen, let's start off talking a little bit about the event and the rankings as well. This event came together some time ago with the idea that there isn't really an event focused on deposits. You and our team had worked to put together deposit rankings in January and then rebooted those ahead of this event to have a nice anchor associated with the conference. What are our rankings? Who do we rank? What are the groups, and what is the approach to those actual rankings?
Just some brief context, Nathan. We have written a lot about and talked a lot about deposits over the last 3 years. The importance of deposits, the competition as the rates went up, cost of deposits and betas. We saw non-interest bearing deposits skyrocket post-pandemic because of the massive amount of deposit inflows. What the banks did with those deposits is a different story, but as the rates went up, customers moved that money into higher yielding accounts more aggressively. And we saw a rebound in that trend with almost all of the growth coming from interest bearing deposits for several quarters. So retaining those deposits, especially after the liquidity crisis in the spring of 23, became challenging. And all of that, I think, combined resulted in this idea to zero in on and highlight some of the best deposit franchises across the country, as we believe deposits represent the true value of a franchise. So we created this model based on our annual performance rankings model, but strictly looking at the deposit side of things. We tested the model with different metrics and finalized 8 key metrics that we believe are the most relevant in the current market conditions and applied different weightings to each metric. Now, these metrics include average non-interest bearing deposit concentration over the last 4 quarters. Just want to mention that we did use 4 quarter averages for most balance sheet ratios to basically avoid having skewed numbers because of one-off items at the end of a period. We weighted this one at 20%. As we all know, these deposits are an institution's most prized deposits. In addition to that, we included quarterly average deposit growth and deposit growth over the last 2 years, weighted at 10%, basically to reward banks that were able to keep the deposit costs low without massive deposit outflows.
And I want to jump in really quick right there. And those two, just I know we're going to get into the other 8 metrics, but I think it's really interesting as you let in too that non-interest bearing deposits are down 30% since year end 21. Interest bearing are up 15, as you outlined. So clearly makes sense that deprives those non-interest bearing deposit concentration. But I also thought it was a great idea that you had to reward stability with the idea there too that you can't just have it fluctuate all over time. And we also didn't just wait on one quarter.
Exactly. Yeah. We had seen like while we were testing the model, we actually did see a lot of fluctuation, especially what has happened in the industry over the last few years. There was a lot of fluctuation, so we want to kind of normalize the data over the 4 quarters, and that gave us better results. But yeah, definitely, and for the growth, we also included banks that had completed deals because we kind of wanted to showcase how some banks did use M&A as a strategy to build a stronger deposit base. And we did highlight them in our rankings as well. Another metric that we used was average deposits to liabilities, essentially showing how banks have been funding the business and keeping a relatively lower cost of funding compared to other borrowing sources. We weighted this one at 10% as well. And then cost of interest bearing deposits for the last 12 months ending June 30, weighted at 15%, which is basically your interest expense relative to your interest bearing deposits only. So even if you have a high non-interest bearing deposit concentration, you would still have to perform better in this metric to be a top performing deposit franchise. And similarly, interest bearing deposit beta, we all know how the betas skyrocketed as well and how much of an impact that had on deposit flows. So we weighted that one at 10% as well. And the bank's reliance on term funding. So we had two metrics showing that. One was time deposit concentration, and the other one was CDs repricing within a year, their concentration, and we weighted both these metrics at 10%. And then last but not the least, a new metric that we created earlier this year for our rankings in January as well, dubbed as deposit efficiency, which essentially looks at the bank's last 12 months non-interest expense, less amortization and impairment, less service charges on deposits, basically rewarding banks for that additional income on deposits relative to the average deposits. We weighted this one at 10% as well. And I do want to mention one more thing that we published these rankings on our platform a couple of weeks ago with the model attached in our rankings article. The model does allow you to change the weightings or metrics, or even if you want to look at a different peer group. So if you have access, you can definitely go ahead and access that model and make those changes. But yeah, that's essentially what these rankings are, and this is how we arrived at the model.
Sure, and the point of being able to tinker with them is a good one for anybody who has access to our platform. We do feel strongly about it, though, and think it lands pretty well, and we've seen some consistency in terms of the top performers. And on that last one too, you and I had talked a lot about how do we come up with a deposit efficiency metric, and we road tested it for a while. But the idea there was there is a cost to managing your deposit franchise beyond interest expense. You've got branches, you've got technology, you've got marketing spend. We talked a lot about those actually at our deposit conference as well. And so there wasn't a perfect way where all of those disclosures are uniform, where you have specific breakouts for some of those items. But we effectively were able to look at, call it a modified efficiency ratio, while, as you said, giving credit for any revenue generated from those deposit bases. And one of the things I shared at the event was when you look at that metric across different asset groups, it's pretty interesting. Community banks and then banks 100 billion to 250 billion have a much higher deposit efficiency metric than the nation's biggest banks, those over 250 billion, as well as larger community banks and smaller regionals. And that's been true for several years. And why would that be? Smaller banks don't have enough scale. The 100 250 billion have a higher regulatory burden. The over 250 have the scale and the ability to spread tech cost across a larger base, and that 10 to 100 billion dollar group doesn't have as much of a regulatory burden as their larger counterparts. So we thought that was pretty interesting. But we saw, when you look at the winners, we broke down in a couple asset groups, and I think it makes sense to hear about those. How do we break those down, and who were the winners? What were some of the attributes?
And definitely agree on your point on coming up with the deposit efficiency metric after we tested quite a lot of things, the deposits per branch, average deposits, and then eventually deposit efficiency worked out the best because it accounted for your digital expenses in addition to your branches. So if we had any branch light models, I think this was the metric that basically accounted for all those caveats that we had with other metrics. But when it comes down to different groups, we have three different asset groups: small community banks, which is banks with less than 3 billion in total assets; large community banks, banks between 3 billion and 10 billion in total assets; and then large deposit franchises, which was banks above 10 billion in total assets. Breaking these down and the winners in each of these categories. So for small community banks, we had more than 3,800 banks eligible for the analysis. So a lot of banks in this bucket. We ranked top 100 deposit franchises. And two Texas based banks, Titan Bank and Tejas Bank, retained their spots from our January rankings, while a Kansas based bank, Integrity Bank, grabbed the second spot. They were ranked fifth in our previous rankings. It climbed a couple of spots to grab the second spot. Titan Bank, obviously, a very interesting and unique model, around 700 million in total assets. It was also ranked among our top performing community banks this year. The bank has very high non-interest bearing deposit concentration, around 55%, which is more than twice the median we had for all the banks in this analysis. I think that was around 21%. They had very low reliance on time deposits and a really good deposit efficiency ratio as well.
With one branch and operating a nationwide business, helping spread that out on scale, it's definitely a unique model.
Really unique model, very low cost of funding, and we have talked about this bank previously as well. Really good numbers for a bank this size. Tejas Bank at number three is a merger target now, as some of these deposit franchises have caught the attention of buyers. Three other banks, I think, in this ranking are now merger targets. And if we look at the large community banks bucket, we had 227 banks eligible for the analysis. We ranked top 50 deposit franchises. And similar to our small bank rankings, the first and third bank from our previous rankings retained their spots. At number one, we had Oklahoma based Stride Bank. And number three, we had New York's Amalgamated Financial Corp, while North Carolina's Fidelity Bank shares rose from seventh spot in our previous rankings to grab the second. We have talked about Stride a lot as well. The bank has fintech partnerships. It offers banking as a service, which may come with its own set of troubles. But we have flagged these items in our full rankings that we published. And we have also talked about this, and we have mentioned, and we talked about this at the deposit conference as well. If you do it right with proper compliance and risk management, you can be profitable and outperform the industry. But if you don't, it could lead to some uncomfortable discussions with the regulators and possible consent orders, which we have seen in a lot of cases over the last couple of years. But definitely, it requires a lot of investment.
Yeah, and picking up on that real quick before we get to the other rankings. I mean, one of the folks at the conference was Brett Farr, CEO of Pathward. We did a fireside chat with them. They're one of the longest standing BaaS banks out there. Trade at 3.5 times tangible book. Really high performer. Have an envious deposit franchise. Almost all non-interest bearing deposits, and they even have a different metric that's not standardized, but where they try to report their all-in costs of deposits, the cost of compliance, because their interest bearing component's so small, but the cost of compliance of managing a BaaS bank against their deposit base, I still, I believe, 1.45%. So 145 bips. That's 60 basis points below the industry. So still a very, very, very strong franchise. But to build on what you said, I think Brett opened with, I'm going to tell you about our model, and I think you're going to learn why you don't want to do this because it's so challenging. So he clearly believes in it, but there is risk that comes with it.
Yeah, it was definitely interesting and good to hear from Brett. And he named a couple other banks as well that have started offering banking as a service. I think Column Bank and Lead Bank, and how they're really good on the digital front. But you definitely got to make sure that you have that investment in compliance as well, or later down the road you're going to have a lot of catching up to do.
Certainly, certainly. So who else rounded out that ranking?
We had the large bank ranking. We had 149 banks eligible for the analysis in this one. We ranked top 15 this bucket as well. The winner in this ranking was a Texas-based EB Acquisitions Company. It's the parent company of Mechanics Bank. It outperformed the median for all banks in the analysis in seven of the eight metrics analyzed, I think falling just slightly short on deposit growth. The bank announced the acquisition of Home Street Inc. in a reverse merger transaction earlier this year, so it has made the news recently. Very, very strong deposit franchise. At number two, we had California based CVB Financial, a $15 billion bank, 15 billion in total assets, very high focus on deposits. The company talks about banking high quality customers who operate with excess cash balances and offers numerous banking products related to data management, fraud prevention, and instant payments. And number three, another interesting bank, $14 billion in total assets, First Financial Bank Shares, a name that consistently appears in our most expensive banks list. Very interesting bank as well. The company has a one bank, multiple regions culture that they talk about, which basically consolidates its operations into 8 regions, allowing them to stay locally focused and build loyal relationships. And the model also enhances their efficiency and supports organic growth. So I think that's definitely something very interesting, which community banks are really good at, and it's good to see as banks grow in size, they continue to follow some of those strategies to basically win on relationships.
You mentioned consistency and high performer First Financial CBVF was either the lowest or second lowest beta this tightening cycle, and they were the lowest in 16 to 19. So it's striking to me. You mentioned how some were past winners in January too. That a lot of these guys have been doing it right for a while and have clearly figured out a really good special sauce that works here. What other commonalities did we see across the rankings? I mean, you just talked about some of the winners, and you had mentioned earlier how we had some Bass banks and some sellers, but what else did we see broadly?
As you mentioned, Bass banks, I think branch like business models, or you can say banks with a big focus on digital, which we've talked about for a while, how digital is becoming like really fundamental for the banking industry now. A couple of banks in the small bank rankings, and I think four, I believe, in the large community bank ranking offered banking as a service. So I think these fintech partnerships are kind of paying off for a lot of banks, even if it's not just banking as a service, it's just partnering up with some fintech firms that's helping out in a big investment on the digital side of things. Briefly mentioned the pros and cons of banking as a service earlier. Another thing that we highlighted was uninsured deposit concentration. So we have already kind of established now that in itself these deposits are not really problematic unless they are concentrated in one sector and there is a liquidity need. But we did highlight those, and I think there were 8 banks with uninsured deposit concentration of more than 50% in our top 50 large community bank rankings. Um, but I think the most common theme in all three rankings was M&A, especially for the large banks. 4 banks in our small bank rankings are merger targets, showing how these deposit franchises are now attracting buyers. 5 banks in our large community bank ranking completed a whole bank deal in the last 12 months. And in our top 50 large deposit franchises, I believe we had 13 banks that completed a whole bank deal over the last 12 months ending June 30. And then we had 2 more deals close after the conclusion of the second quarter. And there were 8 other pending deals among the top 50. So a lot of M&A activity going on there. And I think we could add one more to the list with PNC acquiring First Bank, which was also ranked among the top 50 large deposit franchises. I think on the geographic breakdown, I think there's no real surprises there. We had the most representation from Texas and California based banks in all three rankings.
Yeah, certainly. I mean, people pay up for quality. You mentioned First Financial being high on the list in terms of their price tangible book. A number of these banks that ranked high and had great deposit franchises attracted attention from acquirers, and you and I worked on something very recently that we shared at the deposit conference that really dug into that, looked at the valuation disparity between targets as well as publicly traded banks based on their deposit composition and cost. And not a real big surprise, but banks with higher non-interest bearing deposit concentration get higher values. Banks with less rate sensitive franchises get higher values. I mean, we looked at that going back to 2019, but if you just even zero in this year, if you look at targets with a non-interest bearing deposit concentration that exceeded the industry median They received a median of 161% of tangible book. That's 29 percentage points higher than targets whose concentration was below the median. And, as we talked about, those have been they're always the most surprise deposits, and they've been hard to retain as we've actually seen them decline pretty considerably. Similar thing with the publicly traded group. At the end of August, if you look at those who were above the median on their non-interest bearing deposit concentration, they were trading at 136 of tangible book, 29 percentage points higher than those below the median. And that outperformance, this really struck me because this is not just a new thing, but that outperformance is held all the way back since the third quarter of 22. It's been greater than 25 percentage points, those with higher non-interest bearing deposit concentrations versus those lower. And similar things on the cost of deposit front, where if you had a less rate sensitive franchise, lower cost of deposits, outperforming considerably both in deals and in publicly traded space, the spread being pretty similar, 25 to 30 percentage points of actual spread. And if you look at the highest price deals, I mean, you just mentioned PNC, it's the most expensive deal this year on price to tangible book. If you look at the 15 highest price ones, 11 of those the target had a cost of deposits below the industry median. And in that case, First Bank's non-interest bearing deposit concentration also stood out 33% of the deposits, about 11 percentage points above the industry median. True value of the franchise, it's what people pay for. No real shock there. You and I have run this analysis a few times, but it's interesting that it's holding so firmly, even with the Fed expected to cut today and then maybe again later this year.
The last thing you said was that we have looked at a really long period, and there always has been a correlation. But again, this analysis showed the importance of deposits and representing a true value of a franchise, and just the gap between how these quality deposit franchises are kind of outperforming the rest of the industry. That gap has increased since 2022, I believe, and that really also explains why we did these deposit rankings and the deposit conference. It shows the importance of deposits and how some of these franchises are doing great. Another thing that we did have in that analysis was we also looked at deposit growth, the quarter over quarter deposit growth, which didn't have a similar kind of a correlation as with the other metrics like non-interest bearing deposit concentration or cost of deposits. And initially, I would have thought that there would be some correlation there because of the amount of volatility that we have seen in deposit flows. But if you really think about it, I think it comes down to the quality of deposits. In itself, it doesn't tell you much, but you need to look at other metrics to gauge the deposit performance. And that is what we try to do in our rankings as well. So you can keep your cost of deposits low, but does that mean you're losing deposits at a higher rate? Similarly, you can bring in broker deposits or deposits through M&A, but how much of that you can actually retain in the longer run?
And did you buy it? Did you pay up for it?
Yes.
Is it hot money, or is it if there was a lot of growth and it's warm money? Is one of the people at my table at the deposit conference said maybe that's okay, but you need to look at them connected. And one other thing too, we did in this analysis, we should run this back again. We looked at quarter over quarter deposit growth, whereas in the rankings we gave more of a focus on longer term stability. And so if you had gone back 8 quarters, maybe you'd see a little bit, but it says investors and buyers are a little skeptical about growth in a single quarter, maybe certainly growth for growth's sake. To your point, you need to look at it connected to those other things. One of the things I want to talk about too, though, I mentioned Brett Farr. He was one of the guys we had at the event who has a different model, but you spoke with Esquire Bank at the event as well. And one of the things that we found is that niches work, and particularly in terms of building a deposit business. Tell us a little bit about Esquire. As we close up here, I think that's a good way for us to focus. That yes, all this composition is there, but sort of how do you get there? One of the interesting ways we found it is through niches. What does Esquire do? How are they different?
They target law firms, which is kind of complicated space, but definitely an underserved, or you could say overlooked market. So there was an opportunity there. Obviously, it comes with challenges, but if you're not following the crowd, you have to take that risk. But the reward's great as well, and this is a great example of that. There is an inherent riskiness to the nature of the market when it comes to credit, but that's not really a deposit discussion. And I think Andrew's bank does really well. They do spend a lot of time and money on compliance and risk management. But they are a digital bank. So one of the things they focus on is having the right platforms and products and usability to serve their client needs. They can offer very competitive rates on loans as well, as long as they can bring in the operating accounts, which helps them fund the business. So I think that is really the key. They have a very high non-interest bearing deposit concentration as a result of that, roughly around 33%. Very low reliance on term funding and strong average deposit growth of, I think, 4.5% over the last 2 years. The deposit efficiency was a little bit on the higher end, but again, when you're a digital bank, that's what we try to do with that ratio as well, to basically account for all non-interest expenses. But I think that was the key to their success and makes them one of the best deposit franchises in the country. And I think one of the main takeaways from the discussion with Andrew on deposits was to not dime and nickel your customers.
Yeah, he talked a lot about I remember that about fees and not doing that, and this CEO Andrew Saklioka, and I want to go back to the fees thing, but I pick up on a few things you talked about that I thought were interesting too. I mean, he's a traditional banker. He's from Norfolk, worked with John Candace for years. And when he said he went into this, people thought he was crazy because this is lumpy, but basically they understood the credit risk, and that allowed them to actually price competitively. You'll have to remind me of the numbers, but I think it was we often see people pricing it at 17, 18%, but we can come in at 11. And if you give us the non-interest bearing deposit, maybe at 9. So they can be really competitive, and they've really understood it. And one of the other reasons why they can be competitive and all for that and win that business was the fee component, as you talk about, not nickel and diming. What do you have to say about that?
Oh yeah, yeah, definitely. I think he mentioned that 19%, and then he was asked if he can beat that rate, and he's like, I can definitely beat that rate if I'm bringing in all those deposits. So I think this is how he's running the business, and if you are bringing in enough deposits, and you can maintain that relationship over time without having to worry about rates, why charge them $100 and risk that relationship? And
Right.
I think this was also something that was referenced multiple times during the conference once Andrew mentioned it.
Yeah, we heard it from a number of other bankers who were there, right? Including some who won awards and said, "Yeah, we think it's just silly." And it's interesting because the holy grail for community banks is fee income. So I get it, but they're saying, "Who cares if it means you end up with this fantastic deposit base? You can find assets. You don't even need great lenders necessarily. You can go buy them if you've got this envious deposit base."
And another thing that we did here at the conference, I think, kind of related to this was I found that very interesting. Like, do not try and win or satisfy customers on rate. Try and win them on relationships. And I think this is one of the ways you can do it. If you can't offer a really high rate, you can definitely come up with other incentives, or try to maintain that relationship. And obviously that's what makes these deposit franchises different and unique. If everyone was able to market 5% CDs right now, we wouldn't have any deposit competition. I think that's what they're really good at, and that's what makes it a successful bank.
For sure, and to your point too, not just stay away from rate, but we had some good data and some analytics from some of the folks in the consulting community talking about how rewards programs can really work. But then we also heard on the product side a great panel to close the event from a couple of treasury management professionals, Josh Vogel at S&T Bank, Kelly Dooley at First Bank, and Linda Vasher at Midwest One Bank, really just talking about thinking about the full relationship to your point. And if you're able to do that, then you can really compete. Whereas if you're leading with rate, then the only thing you've attracted the customer with is again that rate. So they're going to be more rate sensitive. So what you need to really do is just employ your people and get products in front of them, and that's how they get really, really sticky. I feel like we heard that a whole bunch.
Definitely.
Well, I think it's a great place for us to leave it. Zain, thanks so much. Really enjoyed the conversation. Really enjoyed the event with you. Look forward to doing it again.
Thank you for having me.